And so here's where the art of investing comes in. I'm telling myself a story. This story is not always going to happen, guys, right? Management can really mess things up. All right, guys, we got a subscriber request here of Elevance Health, ticker symbol ELV. We're going to break down the stock. I'm going to get a price target, take you through my process. If you guys like this, consider subscribing, smash that thumbs up, put down below a stock you may want me to look into. And if I get time, I will try to do my best to get into it. But this is my process on getting a fair market value for an individual stock. So let's get into it. First things first, I like to just look at surface level stuff. How does the chart look over the last 6 months or over the last year? And, it's trading in a range bound situation here where I would say that overall the chart to me looks like it's heading in a downward direction. And I don't really need to rush to anything unless if there's some sort of catalyst pending here. Now, when we just look at surface level stuff, the PE ratio is a 17, which could mean something or nothing. So we don't want to just look at this. We want to compare this to their peers. What else do we see? Well, it does pay a dividend. So that means they're returning capital to shareholders. Not the most efficient way to do so, but they are returning capital. Top line revenue growth has been steadily going up, over doubling over the last 8 years. So beautiful, steady top line revenue growth. Not one setback. It's really rare to see over a very long period of time like that. Normally you'll see, steady growth, but sometimes you'll get a negative quarter or sometimes you'll get a negative year of growth in there. And for this company, very strong top line revenue growth. And when we look at gross profits, those are following. When we look at net income, that is following as well. And when we look at free cash flow per share, once again, the story that it's telling is that it's just a nice straight trajectory on the stock. So these are things we like to see here. This is really good stuff just right off the bat. When we look at the PE ratio versus their peers, it looks like there's some value here. It's trading below pair comparisons on both GAAP and non-GAAP. Price to free cash flow is something I like to look at as well, and that looks strong as well. They do pay a dividend, which is in line with their peers, a little below. And even on the forward PE ratio, we can see here is a pretty good discount as well. And then when we look at the top line revenue growth, the free cash flow, everything is very solid. So far, I got to give this an A just by looking at some surface level stuff. I wouldn't say it's tremendously valued, but I would say that there's a high quality, this is becoming a high quality stock with value. And as Warren Buffett says, you want to buy great companies at good values. And so far, this is looking like a very solid company at good value. For you dividend lovers out there, they are paying a dividend, and it's been consecutive for the last 11 years. And they're growing that dividend for the last 11 years. So specifically dividend growth investors, this one's starting to look interesting because not only have they incorporated the dividend over the last 11 years, but they're growing their top line, they're growing their dividend. Everything in this company is, once again, very solid. So the next question we have to ask ourselves, is there growth in this company? And it looks like analysts are expecting this company to grow very strong. Over the next year, 12.6%. Over the next 5 years, 12.3%. Experts have a price target between 500 to 580. They are buying back stock here, going from 252 million shares outstanding down to 237. So substantial amounts of buying taking place here, roughly buying 2 to 3% a year. So most experts have them doing roughly $235 billion of revenue in 2027. And the one knock I'm going to give about the company or just the sector in general, now this is something I discovered with CVS as well, margins are very slim here. We're talking about very low margin business in healthcare services. So, I don't like that, but I do like the fact that they're growing and they're returning capital and they're doing everything right. Hate the fact that this is a low margin business, but it's also a defensive business. It's probably not going to go anywhere. We need it every day. So once again, guys, I think most of you know that I'm leaning more towards the healthcare sector. I think it's getting undervalued in a market that's really pushing the AI story. And when I think about healthcare, I think AI does help healthcare in a lot of ways. Probably need less people working, which will eventually grow margins. And then the discovery of new drugs, I think AI can help with that as well. And so I think when we think about AI, I really think the healthcare department or the healthcare sector really gets overlooked when AI is being talked about. There's a lot of things that I think AI can do in the healthcare sector that can expand margins and also find new remedies. When I run out my analysis, I have them doing just under 235 billion in revenue. So 234 billion in revenue by 2027 is what I have, with the revenue slowly coming down. And so I'm going to explain how I get these numbers. I know people ask questions on exactly what I'm doing here. So let me explain that as we go as well. So I'm basically annualizing out growth on top line, how that equates to margins and free cash flow, and I'm annualizing that out every single year until I get to 2030, where I put a multiple on enterprise value to EBITDA, and that's how I get a price target with outstanding shares. So I'm adding in or taking off shares depending if a company buys back shares or if they dilute, and I'm taking all these numbers and annualizing them out every single year until I get to 2031, and that's where I get a price target of what I'm looking for. And so here's where the art of investing comes in. I'm telling myself a story. This story is not always going to happen, guys, right? Management can really mess things up. Things could happen. They could lose market share. So when you're projecting out, the farther you're projecting out, the more risk you're taking on. But with a company like this, I think there's a little less risk that you're taking on because we're not putting 20 or 30% projections out there. I think putting 10% projection is pretty high. But I also think that this is something that a lot of experts think they're going to do, and I'm undershooting it by a little bit. The other thing we got to look at is what kind of multiple we want to put on the stock. And right now, it's trading for a 10.4 EV to EBITDA. And when we look at what their peers trade for at 13.3, I think it's pretty easy to meet in the middle here and put a 12 multiple on this stock, especially if they're buying back stock and they're outgrowing their peers. I tend to think that this is a little depressed when we compare them to their peers. So as you guys can see here, from years 1 through 3, I have them growing 10%. From years 3 through 6, I have them growing 6%. And from years 6 through 10, I have them growing 4%, with EBITDA margins between 6 and 7%, which historically they've done. Once again, very low margin business here. They're buying back shares, so I have them buying back roughly 1% of their shares. Their debt growing 1% and their cash position growing 5%, which is about what they've done. I'm looking for a 12% rate of return here. Now that's 12% rate of return, and we have to factor in that they are paying a dividend, and they're buying back stock. When we get a price target of where I'm trying to get a double-digit rate of return, in order for me to get a double-digit rate of return, I have to buy the stock at around 336. And when we look at it from a discounted cash flow analysis, a different analysis than the enterprise value to EBITDA, we're getting a $455 price target. I like to take 10% off just for safety precautions here, which gets us to 410 and 340. So between 410 and 330, between 410 and 340, the stock becomes extremely interesting. I think it's a safe stock, and sometimes for these safe stocks, and when you're talking about like companies like Johnson & Johnson, I think you can pay a little bit of a premium for them because they are a flock to safety and they tend not to have as much beta. And so when we look at the market cap down here at $219 billion, let's compare that to where the market cap is currently. Market cap is sitting at $108 billion currently. Is it feasible that this company can double its market cap over the next 8 years? And I think yes, especially when you look at the sector. So overall, I would say this is a very high quality stock, very boring stock, but I think it's a stock that won't really burn you. Currently, the chart is trading down as the sector has kind of been trading down. The popular trade right now has definitely been the AI trade, and companies like this are definitely getting overlooked, and I tend to think you will have an opportunity to buy it cheaper because it's not really a popular stock right now. It's not a high flyer, and I do think there's going to be some market turmoil to buy this on a dip. But we're pretty darn close to where I think fair market value is to buy this and receive a double-digit rate of return. As I stated before, I think between 340 and 410, you really have to start looking at the stock, which means that probably another 10 to 12% decline here makes this one really interesting. Now, just to give you a heads up, the 52-week high in the stock was at $549, which means that it is down $100 from the high, which means that it's down over $100 from the high. So if you don't think it can go down another $30 to $40, I think it's definitely a possibility. As always, appreciate your time. Thank you so much for spending it with me. Hopefully you all enjoy the dive in. Don't forget to like and subscribe. And if there are any stocks that you want me to take a look at, leave a comment down below and we will get to them. As always, we will see you next time. Peace.